Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, January the 15th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media. I'm here to talk about the economic data, how that impacts the overall markets, and then ultimately how I'm going to add trades to that type of assumption that we come up with through the economic data and the markets. Now, please remember past performance of any trading system or methodology is not necessarily indicative of future results. Having said that, hopefully what I teach you in these daily market commentaries will give you better insight into how to trade options. Is ultimately what we are trying to do here, is educate you guys on the proper way to trade options. I know there's a lot of people out there that will say that they know how to trade options, but I have specific rules that I like to follow in order to increase my probabilities of success with that type of trading. All right, so without further ado, let me get on with the economic data over here, because across the pond we did get some good economic data. Great Britain CPI coming in at 1.3%, expected to be 1.5%. Now, after the construction spending numbers and stuff like that we got yesterday out of Great Britain, or actually on Monday, I believe it was, that it was going to be a little bit iffy how this all kind of worked out with the CPI, Consumer Price Index. It's coming off a little bit. That's really what I would like to see. I would like to see the economy start to go and not see prices start to spike. So to me, at this type of fluctuation point in the economy, I don't mind seeing CPI go down just a little bit. Core CPI out of Great Britain came in at 1.4%, expected to be 1.7%. Now, we're talking about the rest of the European region. We got industrial production slightly lower than expected at 0.2%, expected to be 0.3%. The real thing to note here is they did revise last month's number down 0.4%. From negative 0.5% to negative 0.9%. We don't want to see that type of revisions really going on. Now, here in the United States, producer price index came off a little bit, which is good. That means they're not going to be able to pass on any higher prices necessarily to the consumer. That came in at 0.1%. And then the regular PPI number, that first one was core PPI. And the next one is PPI. That came in at 0.1%, expected to be 0.2%. So that has the food and energy added back into it. All right. And then we also have crude oil inventories coming out. Excuse me. I usually wait for the crude oil inventories. Let's see if we can get that ramped up here. We have a couple of Fed governors speaking. Crude oil inventories came in at a drawdown of negative 2.5% or 2.5 million barrels, expected to be a build of 0.4 million barrels, so about 500,000 barrels, and 2 million barrels off what was expected. We would expect that to drive crude oil higher, but these tensions in the Middle East have really started waning a little bit. There is not enough demand. Remember when we were up there in the 60s, I said that the demand really isn't there, and that the tensions weren't really going to limit production out of the Middle East. It was Iran and Iraq, and they aren't the major producers to really worry about over there. So we are seeing a bit of a drawdown. That is good if you are expecting that to be going into the manufacturing sector and the consumer sector with gasoline. So we're seeing a bit of a drawdown there, but not seeing that reflective necessarily here at crude oil. I've talked about this. Crude oil sweet spot, $55, $56 a barrel. One thing to note, that $59 a barrel, once we got above that into the 60s, right? $59 a barrel and then $60 a barrel, we're going to act as support. They held support yesterday for all intents and purposes. And then today we're seeing that weakness break down below the 200-day moving average. Now, a lot of people will say that that is really bearish for crude oil if we settle below that 200-day moving average. One thing I would say on the flip side of that is we are just basically going right back down to the point of control, which is right there at that $56 a barrel. It's starting to migrate a little bit higher. And that is really the sweet spot. That's where we are going to see the magnet pull this market. That's where most people are comfortable, right? And then see maybe some of this volume start to pick up around $57 a barrel, fill in the the low volume node there that we're seeing over here on the side, right here, this little low volume node create a nice big bell curve there. I don't really expect us to go down and test like $50 or the lower 50s at this point. I think the economy is moving along nicely and can withstand slightly higher prices up into the 55s at this point. I was calling for that, last quarter of last year, that 52 dollars a barrel was probably the sweet spot for crude oil. Now that we're starting to see these economic data points coming out decent, we're seeing the tariffs aren't really doing anything. That's something I forgot to talk about. Right now, algo's getting ready to go bonkers with the grain markets. We are expected to see a signing of a trade agreement with China. It's basically a total of $200 billion worth of products and services from the United States. Grains accounting for, I think, about a quarter of that, very close to it. So could see the grains, depending on where they're talking about allocation of all of this and the real breakdown, which is a bit fuzzy at this point. We could see grains really start to go a little bonkers and maybe even see some upside with the equities, because with all of this trade agreement, we are seeing that they are willing to allow us our trade secrets. Now, before, if you went to China and they stole your trade secrets, well, you had to go to China to try and fight that. Now you are going to have the ability to use the U.S. government to help you in those types of battles. The other thing is like financials going into China still get to keep 100% ownership. Now, most companies, when they start over there in China, China says we get a piece of your business. That's not necessarily going to fly anymore. So really, even now with this shift in the paradigm with China coming to the table, Mexico is really starting to fall in step. So we could see all of these different countries really come back to the table and create better trade agreements with the United States, whereas we've been in the past really giving up a lot of leverage, thinking, if we throw it over there, global economies really start to strive, then that will ultimately help out the United States. We're seeing that wasn't necessarily the case. So this is a pretty good thing for the United States at this point. I didn't agree with the tariffs at all. They did seem to work though. So, I'm kind of eating crow on that one. All right. Anyway, let's talk about gold. It is moving a little bit higher. Some of the volatility is expected with this. We don't really know how this is all going to pan out. So people are being cautious a little bit today and putting money to gold. I think that the chart is setting up for a continuation pattern back down to test $1,500 a barrel mark, which lines up with our point of control here. So that isn't necessarily unexpected. We could easily see the market start to migrate down towards that without really a whole lot of effort, to be quite honest. And then, then we're looking at the bonds. Bonds are starting to move higher. I don't think that this is a product of volatility necessarily or flight to safety, but really a move back to normalcy where the Fed has been talking. We're seeing all these Fed governors come out. They are not thinking about raising interest rates, and raising interest rates would cause the bonds to fall. Remember, it's a teeter-totter. Interest rates go up, the bonds fall, so it's a direct correlation. We're seeing the bonds rise, which means interest rates are expected to lower. Not necessarily lower, but we were pricing in higher interest rates and we're taking that out, which is really where, I've expected those the market to go and head back towards that 160 handle where the point of control is starting to build out. So we'll test that value area high. Value area high, I think, lining up with the Fibonacci that we have here, will act as resistance, but I also believe that it could kind of be almost like becoming like a magnet where it feels like it's a support and resistance as we bounce above and below it, but ultimately we're going to be building out time and volume there. Let's get on with the other markets. We've got the VIX. in higher territory, was off a little bit, but we are seeing the markets really drive higher. You can see here Dow Jones Industrial Average celebrating the agreement with China and up almost 174 points on the day. NASDAQ was the lagger for the most part, but is starting to gain a little bit of momentum here, with it up 22 points and near the highs of the day. Remember, yesterday's high that we're seeing here on the chart is an overnight high. So we want to print that inside of the intraday in order to make this chart look right. That number is kind of a target right now. I would expect that we're probably going to see that get printed today. It does seem like it's a little bit far away to get to, but the markets with the Dow Jones having the high, we see this E-mini S&P right now up, what is that? Up almost 11 points, but it is printing the highs intraday. You know, some people could say that we're going to these blue chip stocks. Those are probably going to be the bigger ones that are affected immediately with the trade agreement. But tech is huge for China, because think, and you know, opportunity here where these trademarks and patents and all of those things that go into building these textile things can now go into China knowing that they have the full backing of the US government to protect them. So tech right now could be a bit on the lagging side and opportunity there. But we can see here E-mini S&P's printing historical highs intraday, which we didn't quite get to yesterday to print that in. We've encompassed that. So chartists and, you know, real economists are going to be talking about that. All right, let's talk about eBay. I'm still in my long eBay because if you guys remember, I did this on an earnings trade quite a while ago, and I went into the weeklies and sold the 37 puts in there for 37 cents. Well, obviously we're below that. I didn't cover that trade, and I got the stock put to me. So now I'm long at this point. Back in October, I was long eBay, right, at $37 a barrel, or at $37. What do we do in that type of situation? Well, we start to become mechanical. And what I had done is gone in and immediately sold the 37 calls in there in the December and collected another 43 cents. So my total collection on this trade is 80 cents. So lowering my basis. I got long at 37, lowered my basis by 80 cents. Now at this point in time, I would have been long at $36.20. Well, I stayed mechanical with that and went in and sold the 36 calls in there for 55 cents. All right. Lowering my basis again, now down below $36 a share to about $35.80, right? Right around $35.80, because I covered those back yesterday for 4 cents. Market is moving a little bit higher, but it felt a little bit toppy. I wanted to get out of those early. You know, those expire on Friday, so they're probably trading right around that mark anyway at this point in time. So not to say that I got out too late or early, or however you want to look at it. Yeah, as a matter of fact, I got out a little too early. Had you waited till today, you can see that they're trading basically for 2 cents. So I left 2 cents on the table. I'm not worried about that. I don't want any big spike and volatility to start expanding in and around the next earnings. So lowered my cost basis in this trade by well over $1, and I'm going to try to get this hopefully back up. If we get up to around $36, which is right there at the point of control, I think the market might want to migrate to that. I'll probably cover that if it happens before the next earnings. Otherwise, I might end up holding this on through that next earnings, but I'm not going to cover this trade before that. The only thing I might do for the earnings is sell some puts, maybe do some dollar cost averaging there, right? Depending on strike location for that. So that's it for today so far. I haven't done anything else with my portfolio, and I'm going to start ramping it up with the next earnings cycle as we get closer to here. We had Target yesterday. They missed on earnings. I'm glad I missed that one because I probably would have played that to the upside with Kohl's missing and a lot of these other retailers. The idea I was thinking was that the consumer was going to be moving to Target for a lot of this. Well, that didn't happen. So it may have rolled into Amazon or some of the other retail sectors. So we're going to have to keep our eye out for that, because it did look like the consumer did come in strong late in the holiday season. So they had to buy something from somewhere, and we'll have to keep our eyes out for that. Didn't happen at Target or Kohl's, that's for sure. All right, that's all I got for you guys. Other than, if you can't take that, take it easy. That was a hit or miss.